Welcome to the People's Lender page. We have a very hot topic today. Our topic is pertaining to the new changes that Fannie Mae and Freddie Mac have made to purchasing a home in terms of having higher credit scores and a higher down payment. There's a lot of information going on. There is a lot of misinformation out there as well. And I'm here to answer any questions and that it pertains to that topic. So what's happening is actually it started back in January. In January, Fannie Mae and Freddie Mac announced that they were making pricing changes to borrowers with credit of higher scores, higher DTI, and larger down payments. However, it kind of slid under the radar. People mentioned it briefly, but I think that because it got postponed at first, and now it's back and they have a hard date of May the 1st, that it's getting a lot of traction and a lot more attention. What I mean by that is if you have a 680 credit score or higher, you will be assessed a small fee for having better credit scores. That's essentially what it is. You will also, if you put down a down payment larger than 10%, you will also be charged something called LLPAs, loan level pricing adjustments. And the loan level pricing adjustments are a small adjustment. It's a quarter of a percent, or we call them basis points. On a $400,000 house, that will change your payment maybe about $40, right? However, the big stink is the fact that you are told to have better credit scores. You're told to have larger down payments. And in this case, you are going to be what they call penalized. Now, let's some questions that I've gotten. It is for new home buyers. So if you're just purchasing a home and you are looking to use conventional financing, this is what will affect your loan. If you have a credit score below 680 and you're putting down less than 10%, it's not going to affect your loan. The information says that they're doing it to subsidize the lower levels of the lower rates, right? I mean, the lower people with lower credit scores. I've listened to a lot of lives and I've listened to a lot of videos about this, and I've done my research. I've yet to hear someone let you know that if you have lower scores, you probably won't get qualified for conventional financing. See, conventional financing is very conservative. So with conventional financing, you can get qualified for a 620 credit score, right? But you have to have superb looking credit profile. You need to have great assets and low debt to income ratio. Typically with a 660 credit score, you don't have a great profile. Let's say you have the great profile. The cost of having a 620 credit score and the cost what it would have you for mortgage insurance would make your payment so high, it would make more sense to go to FHA financing. So let me transition to that. FHA has lowered the mortgage insurance for home buyers. It saves you about $800 a year, right? I think that this rule is helping push people to FHA financing. Right now, FHA financing in most cases is a better bet than conventional financing, no matter what the score is, because the interest rate's typically lower. as well as the mortgage insurance because they made the adjustment. So people, are up in arms about it, not sure what sense it makes, right? But at the end of the day, that's why when you get with a lender, you look at all your options. So some of these price changes are not because lenders are trying to charge more. It's because we have to make adjustments for Fannie and Freddie Mac, Fannie Mae and Freddie Mac. If you don't know who Fannie Mae and Freddie Mac are, Fannie Mae and Freddie Mac are two of the largest servicers and backers of loans in the world. They're not directly tied to the government, but the government has some type of, they're quasi-government entities. So when there's pricing adjustments for Fannie Mae and Freddie Mac that get passed along to the lenders, they have to pass them along to the buyers. They pass them along to the buyers because Fannie Mae and Freddie Mac are going to service or buy our loans from us. So as a direct lender, we fund our loans. We underwrite them, we process them, we fund them, and then sometimes we service them. Or if something was to happen and the person lost their home, Fannie Mae and Freddie Mac back those loans. They pay off the mortgage company, and then they take those loans back in. So in order for us to get the proper pricing or the pricing adjustments, we have to adhere to their rules. So they're not trying to subsidize, they're not trying to make you have bad credit or tell you to have bad credit. I've had people reach out and say, hey, well, I'm going to tank my credit. You're not going to qualify. You're going to run up your credit cards. You may not qualify because there's still so many other factors involved in getting approved, right? So 680 credit score, it may be tough for you to get approved with conventional financing. If you have a little above 680 credit score and you hit a price adjustment, it's for again a $400,000 house, there's a $440 a month payment increase. Does it make sense to me? Not really, but that's essentially what it is. Of course, you have people who definitely don't agree. People who saying people with bad credit don't deserve to purchase a house anyway. And actually, I always tell clients, credit is not who you are. It's where you're at this time. I've seen people with 620 credit scores who don't pay their bills or have a lot of late payments. And I've had people with 620 credit scores who don't have a lot of credit and they don't utilize their credit much. I've seen people with 700 credit scores, and then I've helped people get 700 credit scores just by getting a secured credit card, but they're two different 700 credit scores. The person with a seasoned credit profile is going to get approved faster than somebody who just instantly got a 700 credit score. And let's be honest, the average credit score in America is somewhere around 650 or 660. So there's not a lot of people with super high credit scores when you boil down to it, right? So even if you have a 700 credit score, that doesn't necessarily mean you're going to qualify for conventional financing anyway. And if you do, that's when setting your lender, looking at conventional financing option and looking at your FHA option and allowing for you to compare the cost of the loan to you and your monthly payment and what comes out of your pocket. Again, yes, those price increases are going to happen starting May the 1st. And we knew about it. It just really hit the news last week. However, that's why you get a lender who shows you what to do or lets you know, okay, these are your options on purchasing a home. Which one would you like to go to? So see, that's the key. you don't have to accept conventional financing because it's better. Well, I get, oh, Kevin, well, I want to do conventional because I want to drop the mortgage insurance off. If you can do that with FHA, this is how you do it. You buy the property FHA. After X amount of time, or you have 20% equity in your property, you refinance to conventional. And if you refinance to conventional and you have the 20% equity, then the mortgage insurance drops off. But see, the biggest thing is people don't understand mortgage insurance is not a huge amount anymore. They've done a lot of things to reduce the amount of mortgage insurance. And again, if you go conventional financing and you have a 620 credit score and you get approved, and you look at FHA and you have a 620 credit score and you get approved, you're probably going to go at FHA because your payment's going to be lower, because your interest rate's going to be lower and your mortgage insurance is going to be lower. Let's say you have a 700 credit score and you're looking at FHA and conventional. You're probably going to go FHA because the interest rate is lower, typically going to be lower, as well as the mortgage insurance. If it's not the same, FHA may be a little lower. So we're looking at these things and we're saying, oh my God, they're penalizing us for good credit. They're penalizing us for having a larger down payment. Don't put down a large down payment. If you must go conventional, don't put down a large down payment. What would make you have to go conventional is if the property doesn't qualify for FHA because of maybe a flip rule. So there's a lot of factors into it. I didn't go too in depth. I've seen people put up charts. I've seen people, put up a lot of information that's probably the buyer wouldn't understand anyway, right? However, I did want to get on and talk about those adjustments, the pricing, but also give you a solution. Go FHA. If you're a veteran, see if you have a better option with your VA loan. If you're in a rural area, let's see if you can go USDA. So then, matter of fact, let's look at all your choices. What's better, FHA, VA, USDA, or conventional? So you have choices. Again, if you just jumped on, we're talking about, is Biden really increasing payments for home ownership? Home buyers with good credit, learn the truth, right? They are. It was put out by Freddie and Fannie Mac. And actually, what I didn't say in the beginning is, like, the Biden administration has taken over, taking it on as their project. I don't care what party you're with. Republicans, Democrat, conservative, liberal, that doesn't matter. My job is to allow for you to not get caught up in the weeds of getting charged more. And either way, you're going to be looking at different options for financing anyway. A lot of times I get people who come to me and say, hey, Kevin, I'd like to get qualified for conventional financing. I'm still going to show you your options, FHA, because I think you should know as a consumer, you're listening to say, hey, I want conventional because of this, but you really don't know. You're only going by what you've heard or what you've been used to, or what somebody's told you. So, a good lender is going to give you all your options, no matter what you came for, just so you can make an educated decision on your home ownership process. Hey guys, do me a huge favor. If you are new to this channel or have not subscribed, do me a huge favor and hit that subscribe button. Also, give me a thumbs up on this video if it is being very helpful. With that being said, I see that we have some questions over in the chat that I am going to answer. I'm going to answer questions first pertaining to the topic, and then after the topic, I will answer some of your other questions. So Nathan Thomas says, does this affect new construction or custom homes? If you are going conventional financing, it does. It affects new construction, existing construction, renovation loans. It affects any type of financing that you get with conventional financing. And LaShonda says, so you're being penalized for having good credit and cash. In a sense, yes, but you don't have to play ball. You can take your ball and go to FHA. You don't have to play with conventional. You can go to You decide, hey, I'm gonna go FHA, and figure out later on down the road when you refinance, to get rid of the mortgage insurance if that's a concern, or that's why you went conventional. Is it pushing people to FHA financing? In a sense, there's been a big push to FHA financing. So let's be honest. Let me be honest with you. Before these changes, right now, FHA is the way to go if you're looking at price. It just offered better pricing. The mortgage insurance went down. Interest rates are typically lower. It's just essentially better pricing. So the old FHA that people talked about is not the same. So yeah, FHA is, to me, it's better pricing, probably the better loan right now. Only other thing I think may be better than FHA is VA. So, all right, LaShonda. It says the purpose of the rule changes are designed to level the playing field for buyers that do not qualify for conventional financing. I think they are trying to. There is a push for FHA, right? FHA is a government entity that backs a lot of loans. Conventional financing is typically for the higher credit, more savvy buyer, person with a little bit more cash. But let's be honest, the 40 extra dollars on a $400,000 property is probably a family meal at Chick-fil-A, right? The cost of increasing that amount is what, about $1,280. Let's say if you're a renter and you're looking to buy, that's, as a renter, your landlord probably goes up on your rent more than $50 a month. So in hindsight, it's not really that big of a deal. I think the big thing is, and I read the same thing, is like, okay, you get good credit, you got more money to put down, but you're being charged more. Like, how fair is that? I have seen lower credit score people who are better borrowers than higher credit score people. Now, why would I say that? Because some people don't have much to pay and they don't have long histories. And then you have people who have long histories who don't have that score, but you see they have a great pay history. I would probably lend to that person. Remember, because you have a higher credit score does not mean that you have more money. You don't make more money. You see what I'm saying? It's a funny algorithm. And that's why there's seeming like a million different credit scores, right? So don't let this new rule deter you or get you from pursuing home ownership, because you have options. Conventional financing is not the only option. If you were in the market a year and a half or 2 years ago and they weren't taking FHA financing, guess what? Because of the market, they'll take whatever kind of financing they can get. Some houses are sitting on the market a lot longer than they were. Before, they were sitting on the market for 2-3 days. Now they're sitting on the market for 60, 70, 75 days, which isn't long, but it's longer than it was. So now they need to get from point A to point B. So they're willing to play a little bit more ball with you. So don't let that discourage you from purchasing. And again, when you look at it, $400,000 house, $40 a month, you're just not eating at Chick-fil-A that week. That's essentially what it is, man. Doesn't matter that it came from President Biden. They just took it on, and they didn't necessarily really make the rule. It was Freddie Mac and Fannie Mae. And maybe they're doing it to get a surplus of money so that if we do run into some type of housing crisis, they don't get caught with their pants down. Meaning they don't get caught where they don't have enough money to pay back these lenders because they're backing these loans. See, Fannie Mae and Freddie Mac do not give out money to you. They just back loans. They buy them on the secondary market from lenders and they back them. So we write them to their guidelines and their specifications. Thanks, Miss LaShonda. And thanks, Miss One. So if you're just joining the live or you're watching the replay, do me a huge favor, hit the thumbs up. It helps the YouTube algorithm, and share this out or share my channel with a friend. I come on here to give information, to answer questions, to make sure that we have informed home buyers and to encourage you to become a home buyer. If you have any questions, put them in the chat. It can be about this topic. It can be about home ownership, guys. I'm here to answer questions for you. Actually, when I don't do my lives, I miss you guys. So thank you for coming out. AUCU, is it harder to buy investment property with this change? That's a great question. I don't know. I know that, let me think through it. I know that with investment property, so January of last year, January 2022, there were price adjustments made on investment properties and second homes, which made it more expensive to buy a second property and an investment property. So typically on a second home, you put 10% down, which now you're 10% above, right? Or on an investment property, you're putting down 20 or 25%. So you'll get hit with that adjustment, but let's look at it this way. If you're buying an investment property to rent, lease out, you're really just passing that charge on to your renter. Does it make it harder? I don't think it makes it harder. I mean, you'll see that change, or you'll be charged a little bit more, but just increase. If it's a $400,000 house, just increase what you're going to charge for rent, $40 extra, and you'll make it up. Hopefully that answers your question, AUCU. I appreciate the question. Nathan said, would this also apply to a construction loan? It doesn't apply to a construction loan, but it will apply to your permanent financing if it's conventional. Thanks, Audrey. Thank you, Third Degree Burns. I appreciate you subscribing. Hey, guys, I appreciate you. If you are watching the replay, please subscribe if you have not. Please join my Facebook group. I have a Facebook group that I'm working on because I want to build a community of people who are homeowners, who want to be homeowners. And I'm even going to start talking to you about the investing process. We're going to start doing more in our Facebook group. I'm going to start going live sometimes in the Facebook group. I'm going to start posting more in the Facebook group. So if you got a chance, please subscribe to the Facebook group. We are going to do some awesome things. I am here to encourage you to purchase a home, to become an investor, to buy multifamily, to create wealth for your family. I don't have Twitter. LaShonda. You can follow me on IG at The People's Lender. You can follow me on IG. And I put out videos every day on Instagram. I'm actually going to start going live more on Instagram. So if you, Audrey, if you tap in, if you get my Home Buyers Guide, which is free, it will get your name and email address, and we're also going to start sending out. At this point, I can commit to at least every other week a newsletter to try to give you more information, up to date information, lives that we're going to be doing. So right now, I am going to be building a community. The People's Lender is going to be building the People's Lender community. So any information that you guys have is going to be crucial. Now, what I do also want to say, this community is not just for me. It's for you guys to help inspire each other. Hey, man, I just closed on my house last week. I didn't think I could do it. And that gives you motivation. Any way that I can help is my goal. And I see some words. So S. Evans, I'm a single mother, over 50, making $20K per year. What is my chances of getting a home? Depends on a few factors. It depends on, one, how bad do you want it? How bad do you want to be a homeowner? There are some steps that you can take. Let's say, for instance, first thing we're going to look at is credit. Second thing we're going to look at is income. And then we're going to look at debts and your assets, right? When we look at that, $20,000 a year may not seem like a lot of money to you, but it also depends on what part of the country you're in. Typically, what I find is people who don't make a ton of money typically don't have a lot of debt, right? They don't really use credit as much. However, if you can establish yourself, an option for you, Miss Evans, I was going to call you Stephanie, an option for you could be potentially to get a multifamily property where you live in one unit. We can help you utilize the rents from the other 3 units, or let's say it's a fourplex, other 3 units. We can give you 75% of the income from those other 3 units to help you qualify for more. Let's say you stay in that house. Let's say you stay in the house for 3 years. Then you can purchase another home with 5% down, conventional, fill the 4th unit that you were living in, and use the profits from that property to help you purchase your new home as well as to pay for it with your income. Or let's say you go from a 4 unit to a 3 unit and do the same thing, and you build yourself some rental properties that entail help you save money on your mortgage, helps you come up with a larger down payment, and then eventually it could potentially help you have the down payment and pay for your single family home. That could take some time, but that's an opportunity for you to have home ownership. So to answer your question, yes, it's possible you could become a homeowner. Hopefully that answered your question, S. Evans. Age has nothing to do with it. Doesn't matter. My oldest client was 73 or 74. No, I had a lady who was like 81. She purchased a home. She purchased a home because she said she wanted to leave something for her family. I know an agent who told me her oldest client was 91. Doesn't matter. Age doesn't matter. S. Evans, if you can, reach out to me and let's book a call and let's figure out how we can get you into a house. To answer you guys' questions, I am licensed in Georgia. I actually live in Georgia. So I am licensed in Georgia to help you out. Yep, the things that I mentioned are what we look at. We don't care about age. We care about what do you make? What's your credit score? Do you have assets? Because what we want to know is, okay, we're partnering with this person. Is this person likely to pay us back our money? That's essentially what we're looking at. Put yourself in our situation. I use this example all the time. If I came to you and asked for $20, what are you going to ask me? What you need it for, when I'm getting it back, and then you probably ask us what we need it for again. You're vetting us. Imagine borrowing $200,000, $300,000, $400,000. We want to know the same thing. We know you need it for a house, but can you pay it back? How are we going to get it back? So that's essentially it. Age doesn't matter. We vet everybody the same. I would love to help a single mother purchase. I grew up in a single family home. My mother raised me and grandmother raised me. So I would love to help you out. Casey Johnson, I am licensed in South Kakalaki. So, yep, I'm licensed in South Carolina. Oh, Mr. Rodriguez Burns, no, I'm not only licensed in Georgia. My team and I can help you in Arizona as well. Hey, guys, it's some great questions. Great questions. If you've just joined, please do me a huge favor. Hit the subscribe button, hit the thumbs up button. If you're watching the replay and you have some questions, put them in the comments. Myself, and my team will do our best to answer them and get back to you. I am human. Sometimes I make mistakes and get busy, but do me a huge favor before you blast me on social media, reach back out to me. Charge it to my head, not to my heart. All right. Thank you, Casey. I appreciate you reaching out. I look forward to talking to you. Casey says, my grandmother bought her first house in her 70s. It worked out. My aunt lives there now in the home after her death. That's awesome. That's what it's about. That's what it's about, leaving something for your family. Hey, also, again, I have the Facebook group where I'm going to be very active in. And I also have a free home buyers guide. If you have not gotten the free home buyers guide, click on the link. It'll ask you for your name. It'll ask you for your name as well as your email address. That'll be one way to get on the newsletter. And then this right here, or this right here, where we at? Right here, right there. That's my homeowner's journal. My homeowner's journal is going to help you journal your process through the home ownership. It's 90 pages. It's 90 pages of fire. Budgets, revised budgets, important dates, important information, credit information, how to select the lender, how to select the realtor, your home list. Like, there's so much information packed into this. Now this does have a charge. It's we have it for $19.99, as well as a hardback is, I think, $29.99. It's a great investment. I think it's a great investment. It will help you journal and keep things in place. And it's something that you can pass along to your family to know things about your house, HOA association information, utility information, just all kinds of information that'll help you during your home buyer's journey and after your home buyer's journey. You definitely want to make sure you join a Facebook group. Make sure you get the home buyer's guide so you can be a part of the newsletter. And my goal is to go live every Thursday. Occasionally I can't go live because of other engagements, but I'm going to try to go live more often. What about brainstorming ways to purchase your next investment property? Shonda, you want that as a topic? Because I would love to talk about it. Just a quick hit. So let's say you are looking to purchase a home. Well, let's say you've got your home and you want to purchase an investment property, you've got a couple options. One option is to refinance your home, pull the equity out, and use the equity to purchase another home as like in a down payment for another home for investment. I know what you're going to say. Well, I don't want the higher interest rate if I got a lower interest rate. Cool. One thing to that is if your interest rate goes up, you have more of a write-off because the first 10 years of owning a home, majority of your payment goes to interest. You didn't know that, did you? First 10 years of owning a home, a majority of your payment goes to interest. Okay, you can use that as a write-off as of now. It could help you depending on when you're looking at it. That's currently for the tax laws. Let's say you still don't want to go that route. You can also look into a home equity line of credit where you have a second. So let's say you have a 3.5% interest rate on your mortgage now, but when you go apply for your home equity line of credit or HELOC, they're going to take the equity from the property and put a second loan, and that's a separate payment. It's used as if it's like a credit card for the house. Let's say you had $100,000 in equity and you decide, okay, I'm gonna pull 100,000 out, but I only need 50 for a down payment. Your payment is only going to be based off that 50. As you pay it off, you can use it again. As you use more, your payment gets higher. Those are two options right there on how you can come up with a down payment to qualify for another home. Third option is if you have a 401k, if you can pull money out of your 401k or an investment to create an investment, that's another way to make money on top of your money. And if you have to pay that 401k money back, you're paying yourself back and you've got an investment that's paying you back. So that investment could be paying your 401k back, and then the equity that you're gaining in it and the extra money per month that you're getting can help you create more money, and then you kind of rinse and repeat. So those are a couple options on how to buy an investment property. If you have not purchased a home yet and they have multifamily in your area, that is the cheapest way to purchase an investment property. Don't go to your lender and say, hey, I want to buy an investment property, FHA with 3.5% down. Tell them I want to buy a multifamily property where I live in one of the units and rent out the rest. Most people don't want to do it because they want the mini mansion, but they also want to invest. This is the cheapest way and easiest way to do it. Let's say you're a veteran. That option is available to you as well with a VA loan with no down payment. You're not going to be stuck in that house forever. So I would potentially sacrifice living in a rental property. Living in a multifamily, live in one unit, and rent out the other units to help you pay for your mortgage, as well as an opportunity to build an investment portfolio. I'm going to take it a step further. If I knew and I did it, I would hire a property manager to manage that unit for me, and I would act like I am a tenant, so the other tenants around you don't come say, hey, my toilet stopped up. That's how I would get around it, because I hear people say, well, what if the tenants come and they want me to fix this? They know where I live. They're going to bother me. Outsmart them. Hire property management. Typically, property managers want 10% of the rent. If it's $2,000 that's coming in on the rent, that's $200, but you get a peace of mind and you're only talking to them and you're not talking to the tenants all the time. That would be my way. There's a lot of ways of there's quite a few ways to get in investments. Hard money lenders, borrowing money from people, private lenders. It's a great option. It's a lot of options. Yep, act as a tenant. Then you don't have people saying my toilet stopped up because my kid put a toy in it. Again, guys, this conversation started out with, is Biden really increasing payments for home buyers with good credit? There are some pricing adjustments that happened. They've been on the books really since January. Some lenders have already some lenders knew it was coming, so they've already plugged it into their pricing ahead of time. It's supposed to take effect May of this year. So you probably wouldn't even known the difference. To be honest with you, most buyers wouldn't have known the difference unless the news made a big deal about it. So it's a $40 on $400,000 house. It's about a $40 a month adjustment. One less trip to Chick-fil-A, one less trip to the movies. But I think it still shouldn't deter you from purchasing a home. And again, it should not deter you from trying to have good credit. Don't go up and run your credit cards up. I made a post and some guy said, well, I'm going to go miss a few payments so my scores can drop. You don't want to do that. You want to look at all options, and you want to look at, hey, with this raise, is it going to affect, what's a better option? Is FHA better for me, or is conventional better for me? Heck, sometimes the people getting upset about don't even have above a 680 credit score. So why worry? Or you may not have the extra, if you got the higher credit score, you may not have the more than 10% down. So just think about it, guys. When you go apply and the lender gives you all your options, that's when you weigh it out. What's better for my pockets? Is it FHA? Is it conventional? Is it VA? Is it USDA? Other thing is, if you want to put down a large amount of money on purchasing a home, and you don't want to be penalized. Let's say you want to put 20% down. You can put down 10%. You can get the mortgage, and then after you have the mortgage, you can call your lender, and you can ask them to put down the additional 10%. So your principal goes down, and then you're paying less towards interest over time, and it'll help you pay off the house faster. So there's a lot of different ways that you can get around those adjustments and those changes. If you are just joining the live, I appreciate you for spending this Thursday evening with me. Do me a huge favor and like this video. If you are watching the replay, please do me a favor and comment down below. Again, we have a Facebook group. We've got a free home buyer's guide, and we got a home ownership journal. So the home ownership journal. Join one of those. We're going to be having more interactions. We're going to have more newsletters going out. In case you miss a live, you'll get an email saying, hey, Kevin's going live. If something huge happens in the mortgage world, we're going to put out a newsletter so you know. We're going to post it in the Facebook group so you know. I'm going to call on you. So hit that notification button so to let you know when I'm going live so we can discuss it. Yep, Shonda. Excellent way to get around penalties. That's what I'm here to help. I'm here to help you figure out ways to get around a lot of these things that could be considered issues. So guys, hey, if I don't see any more questions, we can wrap it up. Or, we got 15 minutes that I'm allowed to talk, and then I gotta go. Again, if you think that this information is important to you or someone you know looking to purchase a home, do me a huge favor and send this video out or send my channel out to someone you think it'll help. I think that all of my lives are good. I think all my videos are good. If you want to go binge watch and learn about a topic, do me a favor and go look at some videos. If you have a topic that you would like for me to talk about, do me a huge favor. You can comment below, or you can email me at teamjefferson@summitfunding.net and say, hey, Kevin, could you talk about this topic? I'm always looking for topics that people want to know. It's scrolling at the bottom of the screen. Again, this conversation, this live was about pricing increases to people with considered good credit scores, which is above 680, and if they're putting more than 10% down as a down payment. Again, you can put down 10%, call your servicer or mortgage company after you've purchased, and then put the additional down to help you get around penalties and fees. And if you have 20% to put down, and you have, more than 10% to put down, and you have a great credit score, you still should look at the option of FHA. That would be a great opportunity for you to save money. So it just kind of all depends on what you're looking to do. Miss Evans, please reach out to me and let us see how we can help you. What state are you in, Miss Evans? I'm not sure if you said it or not. Or S. Evans. It could be, yeah, Miss Evans, S. Evans. While we wait for her to put in her state. Shonda, you said Twitter has technology for groups. I'm going to have to get my social media manager to look at that. I don't know if you want me tweeting every day. Again, guys, I appreciate you joining the live. If there are no additional questions, don't forget to share this live out. Winder, Georgia. Okay. Make sure you contact me, please. You're in a USDA area, so housing prices may not be cheap like they used to be. However, it is a USDA area, so you may be able to get in a home with no down payment. And right now in this market, some sellers are willing to play ball and give some closing costs. But let's talk on how we can help you become a homeowner. Hey guys, thank you for tapping in with me. Don't forget the Homebuyers Journal. Don't forget the Homebuyers Guide to help you become a part of the newsletter. And don't forget to like, share, comment, and hit the notification button so you know when I'm joining. And if you have any topic that you want me to talk about, comment below or send me an email to teamjefferson@summitfunding.net. Thank you, Joanne Cuomo. Thank you, and have a great night, guys.